Geopolitics is one of those forces investors sense intuitively, but rarely know how to handle deliberately. Wars, elections, sanctions, trade, disputes, alliances, and diplomatic breakdowns appear suddenly in headlines and seem to move markets without warning. For many investors, geopolitics feels like chaos, something unknowable and therefore best ignored. Others make the opposite mistake, reacting emotionally to every development, as if it were a clear signal to buy or sell. Both approaches misunderstand the true impact of geopolitics on global markets, which is neither random noise nor a reliable timing tool, but a slow-moving structural influence that reshapes risk capital flows and expectations over time. At its core, geopolitics influences markets by changing certainty. Markets do not fear bad news as much as they fear unpredictability. A stable but unfavorable policy environment can be priced. Sudden shifts in alliances, regulations, or power balances cannot. When geopolitical tension rises, investors demand higher compensation for risk, which shows up as lower asset prices, higher volatility, and shifts in currency and commodity markets. These reactions often look dramatic in the short term, but their deeper effects unfold gradually as businesses, governments, and investors adapt. One of the most important distinctions investors must make is between events and regimes. A single geopolitical event, such as an election result or a diplomatic incident, may cause short-term market moves driven by sentiment. A geopolitical regime, change such as prolonged conflict, sustained sanctions, deglobalization, or a shift in global power centers alters the long-term operating environment for markets. Investors who react to events without recognizing regime shifts often trade noise. Investors who ignore regime shifts risk building portfolios optimized for a world that no longer exists. Geopolitics affects different assets in different ways. Equity markets tend to respond initially with volatility, especially in sectors exposed to global trade, energy, defense, or regulation. Bond markets often react through changes in risk premiums and capital flows toward perceived safe havens. Currencies respond quickly, reflecting relative economic strength, capital mobility, and confidence in institutions. Commodities, particularly energy and food, are often the most directly impacted because geopolitical tensions frequently disrupt physical supply chains rather than abstract financial flows. Understanding these transmission channels matters more than predicting headlines. Another critical point is that geopolitics rarely creates entirely new risks. It reveals and accelerates existing ones. Supply chain fragility, energy dependence, technological concentration, and fiscal imbalances often exist long before a geopolitical shock makes them visible. When tensions rise, markets reassess assumptions that were previously taken for granted. This reassessment can feel sudden, but it is usually the result of long-ignored vulnerabilities coming into focus. Investors who study these underlying dependencies are less surprised when geopolitics forces repricing. Geopolitical impact is also uneven across regions. Countries with strong institutions, diversified economies, reserve currencies, and credible policy frameworks tend to absorb shocks better than those without them. Emerging markets may offer higher growth potential, but they are often more sensitive to geopolitical stress through capital outflows, currency depreciation, and financing constraints. This does not make them uninvestable, but it does mean that geopolitical risk must be consciously priced, not assumed away. One of the most common investor mistakes is trying to trade geopolitics directly. Markets often move before headlines are fully understood, and they frequently reverse once uncertainty becomes clarity. Acting on geopolitical news usually means acting late. Worse emotional reactions to dramatic events often lead investors to sell at moments of maximum fear or buy perceived safe assets at inflated prices. Geopolitics tests discipline more than intelligence. The goal is not to predict political outcomes, but to build portfolios resilient enough to withstand them. Long-term investors benefit most by focusing on second-order effects. How will sustained geopolitical tension affect inflation, defense spending, energy, transition technology, regulation, or capital allocation? These slower-moving consequences shape earnings, interest rates, and valuations over years rather than days. While headlines change daily, these structural shifts persist and compound. Positioning around them requires patience and humility, not speed. Diversification is often cited as protection against geopolitical risk, but diversification only works when assets truly respond differently. In a highly interconnected world, correlations can rise during crises, reducing the benefits investors expect. This is why diversification must be thoughtful, spanning not just asset classes, but regions, currencies, and economic drivers. Geopolitics reminds investors that concentration risk is not always visible until stress exposes it. Another underappreciated impact of geopolitics is behavioral. Fear-driven narratives, spread quickly amplified by media and social platforms. Investors feel pressure to act, to do something, even when action is not required. Geopolitical uncertainty often leads to overtrading, abandonment of long-term plans, and misalignment between portfolio structure and actual objectives. The damage here is rarely immediate, but it is lasting. The most resilient investors treat geopolitics as a background condition rather than a foreground signal. They accept that uncertainty is permanent, that power dynamics evolve, and that markets adapt unevenly. Instead of asking, "What will happen next?" they ask, "What assumptions might no longer hold, and how exposed am I if they fail?" This shift in thinking transforms geopolitics from a source of fear into a lens for risk awareness. As global power becomes more fragmented and economic systems more politicized, the influence of geopolitics on markets is likely to increase rather than fade. The challenge for investors is not to become geopolitical experts, but to understand how political forces translate into market behavior, risk premiums, and long-term structural change. Because without that understanding, portfolios are built on fragile assumptions, and learning how to integrate geopolitical awareness into investment strategy without succumbing to reactionary decisions is exactly where we need to go next, by examining how to integrate geopolitical risk into an investment strategy without letting fear hijack decision-making. Because geopolitics should shape structure, not dictate timing. The first discipline is accepting that geopolitical risk is permanent. There is no safe era in which politics stops influencing markets. What changes is the form it takes. When investors accept permanence, they stop trying to trade headlines and start designing portfolios that assume disruption will occur at inconvenient times. The most practical way to do this is through exposure mapping. Instead of asking what might happen next, ask where your portfolio is most vulnerable if assumptions break. Are returns overly dependent on cheap energy, open trade routes, stable alliances, or a single reserve currency? Geopolitical stress usually attacks concentration, not diversification. Mapping exposures forces uncomfortable honesty about hidden dependencies that look fine in calm periods but fracture under pressure. The second discipline is distinguishing volatility from impairment. Geopolitical events often create sharp market moves that feel catastrophic but fade as uncertainty is resolved. Acting during this phase often locks in losses. Structural geopolitical shifts, however, can impair business models permanently by changing regulation, access to capital, labor, or resources. The investor's job is not to respond to every shock, but to identify when a shock changes long-term economics. Most do not. A few do. Knowing the difference is where patience becomes a competitive advantage. Currency exposure deserves deliberate thought here. Geopolitical stress frequently drives capital into perceived safe haven currencies and out of risk-sensitive ones. This can magnify gains or losses independently of asset performance. Investors who understand their currency exposure experience fewer surprises. Investors who ignore it often misattribute outcomes to bad luck. Currency is not an add-on. It is part of geopolitical transmission. Sector and regional balance also matter more than tactical bets. Defense, energy infrastructure, cybersecurity, and domestic supply chains often benefit from prolonged geopolitical tension, but chasing them after headlines usually means paying peak prices. A more durable approach is ensuring that the portfolio is not structurally harmed if spending priorities, trade patterns, or alliances shift. This is resilience, not prediction. Perhaps the most important rule is knowing when not to act. The urge to do something during geopolitical crises is strong, but action taken without a clear structural rationale often causes more harm than good. Long-term investors are paid for endurance, not activity. If the portfolio was built with diversification, liquidity, and risk limits in mind, the correct response to many geopolitical shocks is observation, not intervention. Over time, investors who manage geopolitics will develop a different mindset. They stop viewing the world as stable with occasional disruptions and start viewing it as dynamic with temporary equilibria. This mindset reduces surprise, improves emotional control, and leads to fewer forced decisions. Markets will always reprice uncertainty. The question is whether you are prepared when they do. In the end, geopolitics does not reward speed or conviction. It rewards humility and preparation. Investors who integrate geopolitical awareness into portfolio design rather than trading behavior protect themselves from the most common error-confusing drama with durability. When portfolios are built to survive fragmentation, volatility becomes a feature to endure, not a threat to escape. If this discussion helped you think about geopolitics with more structure and less anxiety, consider subscribing to stay with these long-form conversations, focused on resilience over reaction, and leave a comment sharing which geopolitical risk worries you most, and why. Because naming the fear is often the first step toward neutralizing its power.